What's up, guys? Humphrey here. With the recent stimulus package that Biden just passed of $1.9 trillion and the Trump CARES Act of last year that was over $2.2 trillion, we're seeing a lot of money being pumped into the economy as of right now. In fact, nearly 20 to 23% of all US dollars were printed in the last year alone. That's absolutely crazy to think about. We also know by now that there aren't many great places to put your money. For example, if you save $10,000 at your normal checking or your savings account, which is only paying about 0.04% APY per year, that's only about $4 of interest per $10,000 that you have in the bank. High yield savings accounts still aren't that much better. For example, you can get an online high yield savings account from Ally Bank, and in the past their interest rate was pretty good, but these days it's about 0.5%, which is still kind of leaving you wanting more. The fact of the matter is, cash sitting in a bank account is losing out to inflation, and the Fed typically targets a 2% inflation rate per year. So in today's video, we're going to discuss three things about inflation. Number one, how inflation affects you in the short versus the long term. Number two, what are the effects of inflation on your wallet and your savings? And number three, what are some good investments to protect against inflation? Now, before we start with number one, only a small percentage of my viewers are actually subscribed. So if you do end up finding this content valuable, please subscribe. It's free and you can always change your mind. So there's a ton of money going into the economy, plus the Fed has even said on record that they're okay with a little bit of a higher interest rate, more than 2%. Because of this, we're seeing a lot of investors become a little bit worried about what's going to happen to the economy and the markets in the short to medium term. We're also seeing the 10-year Treasury rate rise to about 1.5%, and that comes with the expectation that inflation is on its way. When Treasury yields rise, it makes stocks less attractive because investors, all of a sudden, if they can park their money in treasuries, which are paying a little bit higher than they did before, well, they're going to move some of their money out of stocks and into treasuries. Because of this movement of capital, we actually might see stocks slide because of that, and that's also why there's an inverse relationship between treasury yields and stock prices. All right, so number one, how does inflation affect you in the short versus the long term? Let's talk about it. Now, inflation in the short term doesn't have a direct relationship with falling stock prices, but what inflation does have is that because of this expectation of inflation, we're seeing interest rates rise. And when we see rates like interest rates or treasury yields rise, those have a negative impact on our stock prices. Let's imagine you have, let's say, an interest rate of 12% that the bank is offering you to hold your money with them. You know that the stock market historically returns 8% per year on average, but when you hear that the bank is offering you 12% per year and it's risk-free, well, what are you gonna do? You're probably gonna move all of your money from the stock market into that bank account. Because you can get a higher return in the bank, what you end up doing is you sell off your stocks. So that's basically what's happening here. Because there are higher rates elsewhere, a lot of investors, especially institutional investors, are selling off a portion of their stock holdings to liquidate that and get higher yields elsewhere. Now, interest rates aren't at 12%, but rising interest rates and the expectation of rising interest rates, as well as higher treasury yield rates, are going to force some people or some institutional investors to move some of their money out of the stock market into other places. So that's why in the short term, inflation can affect interest rates and thereby affect stock prices negatively. Higher interest rates are usually correlated with lower stock prices, and lower interest rates usually are correlated with higher stock prices or stocks going up. I think this is part of the reason why we're seeing tech stocks slide in the past few weeks. It's because of this looming expectation of inflation, but that also creates an opportunity for us in the short term, because all of a sudden, if we have cash sitting on the sidelines, but we see a good deal on the stock market, well, that's a good opportunity for us to pick that up. In terms of how inflation affects you in the long term, most financial planners typically assume that the inflation rate is going to be set at 2 to 3%. That means in the long term, you should be at least targeting a 2 to 3% return on your money, or get a raise at work, or just find a way to actually grow your money by 2% a year. One of the things that you can do is invest in yourself, because by consistently investing in yourself, you could be able to outpace inflation just by increasing your income by a higher proportion each year. Inflation in the long term will happen no matter what. It's kind of like when you're talking to your parents or your grandparents and they're like,
"Oh, son, gas used to be 25 cents a gallon back in my day."
Well, that's because of inflation, and it's kind of inevitable. So hopefully our income is keeping pace with inflation or even a little bit higher than that. And also we're investing in things that protect against inflation, but we'll talk about that a little bit later on in this video. Let's discuss the effects of inflation on your wallet and your savings. And there are actually 4 points that I want to talk about today. Number one is the cost of living. Now, if you do nothing about inflation, your cost of living is just going to get higher and higher every single year. The more that prices go up, you're going to be spending way more money on things like gas, groceries, entertainment, and even bigger ticket items like cars. To beat a higher cost of living, you want to focus on increasing your income like we talked about earlier, but also when it comes to bigger purchases, like for example, buying a car, you might want to buy those ASAP, because something that might cost $5,000 now might cost $5,200 next year if inflation is at 4%. The second point I want to talk about with inflation is the actual topic of debt. Now, inflation is actually pretty good for debt because if you think about it in theory, you'll actually pay less in purchasing power for the same amount of debt that you do have. Obviously, if your interest rate is super high, you don't want to just like wait around for inflation to happen so that you can pay a little bit less. You still want to pay that off as fast as you can. But if you are going to be in an inflation high environment, for example, that is actually a pretty good thing for your debt. It's actually pretty good for fixed rate mortgages because the payments on a fixed rate mortgage are the same every time. As time progresses with inflation, you're actually paying a lot less in purchasing power for that same payment. So if you're needing a loan right now or you're thinking about refinancing a loan, now might be a good time because banks are constantly adjusting for inflation and adjusting their rates. The third point I want to talk about is savings. Now, when it comes to inflation, inflation is really bad for people that just save cash. If you're keeping your money in cash, if you have $100 today, well, in a year, that's going to be worth about $96 if inflation is at 4%. And that same $100 after 5 years will be worth 1/5 less or about $81. Since savings aren't paying off, you don't want to keep more money than you need to in your savings account. Now, obviously, you still want to have your emergency fund and set aside some money for retirement and things like that, but the rest of your cash should be invested or in something that's appreciating more than 2 or 3% per year. The fourth point I'd like to talk about are salaries and wages. Now, as inflation goes up, hopefully your salary and your wages go up as well. However, with some of the lower paying jobs out there, such as in retail or restaurants, for example, or anything that pays closer to minimum wage, inflation might actually negatively impact you. The workers who suffer the most from inflation are those that are closer to minimum wage. And since minimum wage hasn't even been changed since 2009, it negatively impacts them even further because now everything's a lot more expensive. The best thing that you can do if you're earning closer to minimum wage is to 1, look for side hustles, 2, try to invest in yourself because investing in yourself will hopefully get you more skills, which will hopefully get you more income. 3, try to ask for more responsibility at work, maybe get onto a management track of some sort. Or lastly, you might want to just switch industries altogether if you're just having a hard time breaking through that glass ceiling. Okay, so that's how inflation might affect your daily bottom line and your wallet and your savings. But now let's talk about what types of investments that you can invest into that will protect you against inflation moving forward. So the first type of investment that I'd like to talk about is actually called TIPS, or Treasury Inflation Protected Securities. Now, TIPS are investments that are offered by the government, and they're typically linked to inflation at a 1-to-1 ratio. So as long as inflation goes up, then your investment goes up along with it proportionally. Now, in terms of buying TIPS, you can buy them via ETFs. So some of the best ETFs out there for buying TIPS are ticker symbol IVOL, ticker symbol TDTF, and lastly, ticker symbol SCHP. The thing with these tips though is that they're probably going to underperform the broad market, but they'll offer you more stability and a little bit less risk than, say, investing in the S&P 500. For example, that ETF SCHP has an average annualized return for the past 5 years of around only 4%. Compare that to the S&P 500 ETF, which has an average annualized return of about 16%. The difference is that the downside might be greater with the S&P 500 ETF than it is with the tips. The second best investment that you can make to protect against inflation in the long term is still the stock market. The stock market is going to be riskier than buying treasury inflation protected securities. However, it will offer an annualized return of around 8% if you stay in the market long enough. The main takeaway here is to continue investing and to stay invested as long as you're not near retirement age or you don't need the money anytime soon. According to this graph by T. Rowe Price, we see that stocks are the long-term driver of growth. Tracking the growth of $10,000 over 25 years, this graph shows you that if you stayed in cash, your investment doesn't really grow that much. But over that same period of time, if you were invested in the S&P 500, it yields a much higher return. Your $10,000 investment would basically become 8 times worth as much. The third type of investment to beat inflation is to diversify your portfolio among all different types of asset classes. If you're able to diversify, you're basically protecting yourself against not only inflation, but also possible downturns in the stock market. I think real estate could be a really good hedge against inflation because as inflation occurs, at least you own something that's tangible and real and it's sitting there and basically it's appreciating in value as more and more money is being pumped into the economy or more inflation is occurring. Another alternative investment that a lot of people are getting into these days are commodities such as gold or, for example, even Bitcoin, because Bitcoin is becoming more known as a store of value these days. In terms of safety though, Bitcoin is a lot more volatile than other types of investments. Now, in terms of the recent price action, what we're actually seeing is a lot of people are putting their money into Bitcoin because there's simply no other great place to put their money right now. Just know that if you invest into cryptocurrency as a hedge against inflation, that might not work out. I'm not saying it will or it won't, but it is a lot more riskier, so just be aware of that when you're investing into something like Bitcoin. So we don't know how inflation is going to manifest itself over the next coming year, but we do know that the Fed is targeting a 2% inflation rate and that they're okay with a little bit more inflation, which actually might be a bad thing. I do hope this video was helpful giving you a background on inflation and how to actually beat inflation. If you'd like a free stock from Robinhood, make sure to use the link in my description below for that. You get a free stock whenever you deposit any amount of money, even if it's just $1. Thanks to all my Patreon supporters for being here. If you'd like to see what I invest in and also get alerted whenever I buy and sell a stock, I offer that in my Patreon, linked below in the description as well. All right, guys, I'll see you in the next video. Peace.